Good morning, gentlemen. My name is Matt Sauer, and I'm from Durham, North Carolina. Many businesses are reporting rising costs and surcharges on such inputs as fuel, metals, and wood. They are often unable to pass along these costs to their consumers. If commodities stabilize at price levels above those of the past decade, will corporate margins be compromised into the future?
Well, it's a great question, and I would say that would depend very much on the industry you're talking about. But in our carpet business, for example, we've just been hit time after time, as I mentioned in the annual report, with raw material increases because there's a big petroleum derivative factor there. And we have lagged in terms of being able to put through those increases to our customers simply because we want to protect the Nebraska furniture marts, or those that have ordered for a reasonable period of time, and that's squeezed margins in carpet. We use lots of natural gas at Johns Manville. Use lots of natural gas at Acme Brick, and that's tended to squeeze margins some. I think over time, I think there has been a lot more inflation in these basic materials. Steel has been off the chart. I think over time, the businesses with strong competitive positions manage to pass through increases in raw material costs just as they pass through increases in labor costs. But you get these temporary situations where sometimes the costs are increasing faster. I don't think the American industry, I mean, a higher cost for oil when we import 10 million barrels a day or more of oil, if we're paying $20 or so more per barrel than we were a year or two ago, that's $200 million a day is a tax. But it's more of a tax on the American consumer probably than on American business. The American business will probably be able to pass through most of those raw material cost increases. It is worth pointing out that corporate profits as a percentage of GDP are right at the all-time high, leaving out a few aberrational periods. And I would, if I had to bet on the direction of corporate profits as a percentage of GDP over the next 5 years, I would bet they would go down somewhat. But that's because they're right at this very, very high level. Interestingly enough, while corporate profits as a percentage of GDP are at this very high level, corporate taxes as a percentage of total taxes raised in America are very close to an all-time low. So American businesses managed to pull off a situation where they're making extremely good profits and paying a very small percentage of the total tax bill as measured in this country historically. And I'm not sure whether that could or should or will continue. But it's a very, very favorable period right now for corporate America. But that's nothing to get bullish about because you might expect something of a reversion to the mean. Charlie?
Well, I can't add to that, but I can restate it. It's hard to know just which companies can pass through the increases in cost that come from higher commodity prices, and it's also important to know.
We like buying businesses where we feel that there's some untapped pricing power. We haven't been able to do much of that lately. But back in 1972, when we bought See's Candy, I think it was it $1.95 a pound?
Something like that. Yeah.
And they were selling 16 million pounds of candy a year, making $4 million pre-tax with about $25 million purchase price, which I would have very foolishly refused to budge on, and in history have cost us a lot of money. But one of the questions we asked ourselves, and we thought the answer was obvious, was, if we raised the price 10 cents a pound, would sales fall off a cliff? And of course, the answer, in our view at least, was that no, there was some untapped pricing power in the product. And it's not a great business when you have to have a prayer session before you raise your prices a penny. I mean, you were in a tough business then. And I would say you can almost measure the strength of a business over time by the agony they go through in determining whether a price increase can be sustained. And frankly, a good example of that is the newspaper business right now, because 30 years ago, when whatever the local daily would be had an absolute lock on the economics of the community, because it had the megaphone through which merchants had to talk if they were going to get their message across to their audience. At that time, rate increases, both circulation and advertising, were something that were almost a big yawn to most publishers. They did it annually. They did not worry about the fact that Sears or Walmart or Penny's or whomever would pull their advertising. They did not worry that people would drop their subscriptions to the paper. And they went merrily along, increasing prices, and they increased them when newsprint went up, and they increased them when newsprint went down. And it worked. And you got these very fat profit margins, and it looked like about as strong a business as you can imagine. Now publishers find themselves in a position where they agonize over rate increases, both in advertising and in circulation, because they're worried about driving away advertisers into other media, and they're worried about people when they get a 20-cent increase, per month or whatever it may be, in their circulation price, just deciding, well, I think I'll just drop it. And when they drop it, they don't usually take it up again. So that world has changed, and you could recognize the change in that world simply if you could get inside the mind of the publisher in terms of how they felt about price increases. You can learn a lot about the durability of the economics of a business by observing the behavior of the price behavior. I mean, you're seeing that. We're talking about the beer business. The beer has moved up in price every year, but there have been some rollbacks in certain areas in the last year, which means that it's getting a little bit more difficult to increase prices, even though they increase them at rates below inflation. And that's not a good economic sign. Charlie?
I have nothing to add to that.
Okay, we'll go to number 7.